Hello class, it's Professor Choi again. Today we're here to talk about fiscal policy. Fiscal policy is basically when the federal government makes changes to economic activity by changing either government spending or taxation usually. So fiscal policy are basically changes in federal taxes and on federal purchases that are intended to achieve some kind of macroeconomic policy objective like high employment, price stability, and economic growth. Now, the reason the government intervenes in the economy is because they passed something called the Employment Act of 1946. And the Employment Act of 1946 basically commits the federal government to intervening in the economy to promote maximum employment, production, and purchasing power. So basically, it is the job of the government to help the economy when unemployment is going up or when the economy is faltering. And that's basically what the Employment Act of 1946 does. Now, to understand how important this is, by the way, if you would have been around before 1946, it really was not the job of the government to intervene in the economy. And that was one of the problems, the major problems we had during the Great Depression of 1929, is that the government was extremely inactive because it really wasn't their job to intervene. So what they would do is just kind of like watch it from the side. All right, now, there are two basic ways in which the government intervenes today. We have what we call the automatic stabilizers. The automatic stabilizers are basically government spending and taxes that automatically increase or decrease along with the business cycle. Such programs like progressive taxation, which is the way we collect income taxes in the US, unemployment compensation, or welfare programs are part of these automatic stabilizers. The automatic stabilizers is basically a set of laws that the government has been using because they understand that they cannot get together every time there's a recession and agree on everything that needs to be done. If you live in the partisan environment that we live in today, you would understand what I'm talking about. But basically, what they have done is they have passed laws and regulations that will do their job for them until they get to the point where they can also help the economy by themselves. Then you got discretionary fiscal policy. Discretionary fiscal policy can be either expansionary or contractionary because the government can either make the economy bigger or smaller. And it's basically changes in government spending or taxation at the discretion of the federal government. A really good example of this is the American Recovery and Reinvestment Act of 2009. And the recently passed, since this video is being done in 2020, the $2.2 trillion plan to save the economy in the year 2020. All right, so let's engage in a conversation about the automatic stabilizers first. So we have programs like we have things like progressive taxation. Now remember, income taxes in the US are progressive. What that basically means is that the higher progressive. What that basically means is that the higher the income or the more income you make, then the higher the marginal tax rate that you have to pay. So basically, when income goes up, you pay more taxes. Another thing we have is unemployment compensation. Unemployment compensation works like insurance. So basically, you pay into it when you work, and you get it when you lose your job. Okay? So basically, it's like a big fund. And then when the economy is doing well, everybody's putting money into it because there's more people working than there's unemployed. And then when the economy turns south, then you withdraw from the fund until the fund runs out of money. Another thing we have is welfare programs. People call it food stamps or Medicaid, for example, which is insurance for the poor. Etc. All right, now let's talk about how does this relate to the job of the government. And to understand it, let's just think about GDP. So GDP is basically consumption plus investment plus government spending plus net exports, which again you use an X or XN. Okay. So what normally happens when the economy is slowing down in a recession, the consumption sector declines and the investment sector declines. Now the consumption sector declines because we stop buying stuff and we start saving more money because the future is uncertain and we don't feel like we're comfortable buying. So basically the desire that you have for savings and sheltering your money is what creates a recession because it lowers the level of consumption. Investors are looking at the business environment and they're thinking, oh my God, probably I don't want to put more money or invest in a new factory if I don't know what the future is going to hold. So they hold back a lot of the plans that they had. In order to basically help the economy, the government has to behave opposite to what's happening. So the government has to increase government spending and or they have to cut taxes. Now, the reason they cutting taxes works is because if you cut, say, business taxes, then some businesses are going to have more incentive to put money back into their businesses. So investment may increase. Or if you cut individual income taxes, then some of that money people may decide to consume. So the process of decreasing the amount of taxation that the government charges you creates opposite effects in consumption and in investment. All right? And that's basically the job of the government. Now let's take a look at what happens with these automatic stabilizers when real GDP declines. So when real GDP decreases, that was supposed to be a D. So when real GDP decreases, we're going to collect less income as a team. So our income level declines. And we're going to be using the letter Y for income. Now, because our income level declines and we have progressive taxation, then basically as a team, we're going to be paying lower taxes. Because as a team we're paying lower taxes, then you're going to see a desire and increase some consumption in the economy because again of that decrease in taxes or an increase in some investment in the economy. All right? Again, that happens automatically because we have progressive taxation in the system. So as real GDP decreases, income goes down, taxes drop. All right, unemployment compensation. When real GDP is declining, one of the things that you're going to notice is that unemployment is going to increase. There's going to be more people filing for unemployment. As there's more people filing for unemployment, then the amount of unemployment compensation, which comes from a government fund, increases. So now increases in government spending are coming. A lot of the times when the fund runs out of money, so imagine the fund being like a pool of money, and then you kind of like went through the pool, then the next thing that happens is the government will have to kick in and put more money into the pool by basically borrowing more money. So government spending has to increase to put money on that pool. Then you get the welfare programs. As income decreases, a lot of people will start qualifying for poverty payments. In other words, more people will become quote unquote poor. And remember, there is a sort of line that you have to cross to become poor, and that all depends on qualifications on the programs and whatever. But basically what happens is the amount of quote unquote people that are poor will start increasing. As a consequence of that, there'll be more people collecting money on things like food stamps, Medicaid, and anything else that is a welfare program. So the welfare program expenses are going to go up, and that's the same as an increase in government spending. Okay? So notice that this set of laws that we have in place create already the behavior that we want from the government because it makes taxes go down and it makes government spending go up. And again, that's what you want if you want to support economic activity. A big side effect of this behavior is national debt, because when taxes drop, the government is collecting less money than before, and when government spending goes up, the government is spending even more money than before. As a consequence of that, the national deficit will go up. And the national debt will go up. All right, again, let me point you to a website that we have been using regularly in the class to explain the problem about national debt. All right, so this is the U.S. national debt clock. And wow, so if you would have been around not very long ago, and I'm talking about a month ago, and we have been looking at this. And by the way, again, just to keep track of this particular video, so this is done in March. This is April 2020. So if you'd have been around in January 2020, then the federal deficit would have been at around $1 trillion, or maybe below $1 trillion, and we would have been talking about how that was a really bad number. The federal government just passed a stimulus plan to help the economy in 2020, and as a consequence of that, notice what has happened to the budget deficit. Okay, notice how the level of taxation is in decline right here, and notice how the level of government spending is increasing very rapidly. The difference between those two numbers, aka the revenue and the taxes, is the deficit, and the deficit is the amount of money that we're borrowing right now, extra every year. You notice that that number is on the increase. The deficit that you see right here, by the way, it's basically now the largest in history, or very close to the largest in history. This is larger than the previous largest in history, was which when President Obama was in office in the year 2009 or so. By the way, there's a debt clock machine here, so we can go back in time if you want to look at that. Okay, so this is the how the debt clock used to look in 2008. Okay, fast forward to the year 2012. All right, notice that this was basically almost the largest deficit in history back in the year 2012. And the number that we have right now is the largest deficit in history. All right, let's talk about discretionary fiscal policy. Discretionary fiscal policy is basically when the automatic stabilizers are not considered to be enough, and the government basically comes in and it really sends a big shock wave through the system by spending a lot of money. Now, to understand which type of expenditures the government will normally do, let's talk about the difference between a government expenditure and a government purchase. The government has to spend money all the time on things that they run. So think about people that work for the government, regular interest payments on the national debt, spending that they normally do, etc., etc. So there's a sort of basic expenditure that the government has to do. Now, changing those basic expenditures helps economic activity, but there are particular expenditures that tend to help economic activity more, and those are what we call government purchases. A government purchase is different than a government expenditure. I mean, a government purchase is a government expenditure, but it's a sort of government expenditure that normally works better to help the economy. A government purchase is when the government decides to buy a physical thing from the system, something like an airplane, a tank, a chair, a desk, or something of that sort. The reason this is stronger is because it creates a sort of ripple. When the government buys something from a company, and remember, the government doesn't produce things. I mean, they do produce some things, but in general, they don't produce everything. So when the government decides to buy something from a company in a purchase, then that particular company now has to figure out how to build it. And when they get this big contract from the government, the first thing that they're going to do is they're going to have to hire a lot of people to comply with that contract. So providing companies with government contracts creates this increasing hiring, and it also creates this increasing purchasing, because the company is going to now have to need some resources that they may not make themselves. So an injection of a government contract into a company basically generates this extra hiring and this extra purchasing, which creates a sort of positive ripple in economic activity, because it creates an injection of money at the bottom, but then it creates a sort of hiring process which is good, and expenditure process which is good, from a company to another company to another company, and that supports economic activity, and it creates an upward spiral in the economy. In other words, it makes GDP go up. All right. Now, there are two basic ways in which the government can move the economy. One is what we call expansionary. Expansionary fiscal policy is when the government tries to shift the aggregate demand to the right by either cutting taxes or increasing government spending. One of the side effects of this is that you might create what we call demand pull inflation. And then you have contractionary fiscal policy, which is when the government decides to kind of fix the budget, because if you spend too much money, eventually you're going to have to fix the budget. Either that or you go bankrupt. And the government has to cut back on the amount of expenditures, and they have to increase the amount of taxes. So let's talk about expansionary fiscal policy. Now remember, we're using the aggregate supply, aggregate demand model. So this is the ASAD model. On this side, we have real GDP, which we're going to be using the letter Y because it's easier for me to write. And then on this side, we're going to have prices. And again, we use the letter P for that. All right, then we have a line which we call the aggregate supply, and then we have a line which we call the aggregate demand. So this is our short run aggregate supply, and this is our aggregate demand. All right, so imagine that the government decides to pass a huge stimulus plan like they just did now in March 2020. The stimulus plan basically includes tax cuts. In other words, people are going to be receiving some money, and it includes increases in government expenditures. So in other words, it includes both things that are expansionary. What this is basically going to do, or what it's supposed to do, is the tax cuts are supposed to increase the level of consumption compared to before, and they're supposed to stabilize or increase the level of investment activity in the US. So both of these are designed to basically make your aggregate demand shift to the right. Okay, so when the aggregate demand shifts to the right, we're going to go from aggregate demand 1 to aggregate demand 2. And as the aggregate demand is shifting to the right, and this might take a while, by the way, it's not like these things happen like in a video game, you know, a few minutes later. These things in an economy take a while. So we're going to go from this level of economic activity, call it Y1, and this level of pricing, to some higher level later on in the future. So an increase in the level of aggregate demand eventually creates an increase in real GDP, and eventually it also creates an increase in prices. So you should expect and again, there's no time for this, okay? But sometime in the future, say the year 2021, 2022, you should expect some inflationary pressures, and then you should also expect the economy to quote unquote recover. And that's really what a stimulus plan is for, or at least what it's supposed to do. All right. Now, how good is this effect? Well, the effect is good. We've used it before, all the way back to 1929, 1936 or 33 or so, by the way. The first time, or I wouldn't say the first time, but the first major time we had this sort of concise effort to create a stimulus plan in the U.S. is the New Deal during the Great Depression. Right? And if you want to read a little bit more about the New Deal, here it is. So basically, it was a huge amount of public work projects that were created by the federal government between the year 1933 to about the year 1939. And most people credit this New Deal with the getting out of the Great Depression. Okay? So this was a sort of huge amount of government expenditures that generated lots and lots of economic activity that you could measure, and it was basically the getting out of the Great Depression. In many ways, is what kind of got the U.S. economy out of the Great Depression. So anyway, if you want to read more about that, there it is. All right. Now, fiscal policy has a tendency to take longer than monetary policy, but it also has a tendency to create longer effects because it creates a sort of ripple that lasts for longer periods of time. Not to mention, the government doesn't really have the amount of money that they normally say they're going to spend, so they don't spend it right away. It becomes a sort of 2, 3, 4, 5-year program where they dump the money in the economy in like chunks. Okay? So if you look at the stimulus that they passed in March of 2020, the first money that you should expect is really that money that's going to be transferred to taxpayers. And then right after that, a lot of loans for companies and the money that's coming into the unemployment office. Now, fiscal policy has a time problem. It takes a really long time to discuss and debate. It takes time to approve, and it takes time to sign and pass. Now, this portion is fine, and I don't know if you noticed, but in the year again 2020, this time was very short in the sense that it took about a month for the government to figure out what they were supposed to do. And then they approved it and passed it and signed it. The real problem is over here in the implementation side. The government doesn't really have all the money that they promised that they were going to spend. The government has to borrow most of that money, if not all of that money. And the monetary system just doesn't have the capacity to let you borrow that much money that quickly. Not to mention, you can push interest rates up, which is bad for what's happening right now. As we were explaining before, if interest rates go up, then economic activity tends to slow down. So as a consequence of that, the implementation side, which is when the government has to go and borrow the money and then spend it, takes longer than we would like. All right, now this slide explains a little bit about what we call the multiplier effect. And the multiplier effect is something that helps economic activity. This is our how we're going to what we call estimate the multiplier effect. The multiplier effect is a sort of ripple effect that is generated after the government starts creating their first expenditures. Now, to understand the multiplier effect, let's go back a little bit and talk about something called the marginal propensity to consume. So imagine that you have a marginal propensity to consume of, say, 0.9. Now, marginal propensity to consume of 0.9 basically means that if I give you $1 today, so if I transfer $1 into your pocket, then you're going to take 0.9 of that, which is 90 cents, and you're going to consume it. So consumption will go up by 90 cents. That's what 0.9 means. So you take the 1, multiply it times 0.9, and then 90 cents is the level of consumption. Now, if you have a margin of propensity to consume of 0.9, it also means that you have a margin of propensity to save of 0.1, because the marginal propensity to consume and the margin of propensity to save has to add up to 1. So again, what that means is that whatever you don't consume, you save. That's what it basically means. Okay. So if you have $1 in your pocket and you consume 90 cents of it, that basically means that 10 cents you put it on the piggy bank, and then your savings go up by 10 cents. All right, but notice though that these 90 cents on expenditure, it's an expenditure for you, but it's an income for somebody because you spend it on somebody's business or somebody's thing. Okay, so basically that consumption spurs farther economic activity down the road. So let's think about the next step. Now let's assume that the margin of propensity to consume stays the same for simplicity purposes into the next step. Okay, so that basically means that whatever money you spend, you consume, you're making it into somebody's income. That person who receives the income is also now going to either spend some and consume some and save some. So if you look at 0.9 and 90 cents, that person is going to spend 81 cents. And 81 cents, by the way, is 90 cents times 0.9. So they're going to consume 81 cents. And then they're going to save the other 9 cents of that, which is the 10 cents times the margin of propensity to save. Now this consumption level is consumption for this person, but it becomes income for somebody else. And this continues through the consumption cycle. So this money that you see right here is the initial amount that comes in. And you can think of this as being the sort of government expenditures push. And then everything after this, it's an increase in consumption, another increase in consumption, then another increase in consumption. And that's the ripple effect, or what we call the multiplier effect. Okay, so the multiplier effect is all the other expenditures that are going to happen after the original expenditure has happened. So this is a sort of autonomous originator expenditure, and then everything else is what we call multiplier effect. Now, what does that do for our aggregate demand? Well, what it basically does is it creates a movement to the right and then a sort of ripple that will continue to move that aggregate demand to the right farther than the initial amount. So the total effect of the aggregate demand moving to the right, it's going to be this sort of initial shock in the economy, and then all the other ripples that come right after that. All right, now let's talk about the difference between doing a change in government spending and doing a change in taxes. And let's put some numbers on it. So imagine the government wants to spend $1,000. Again, let's try to keep it simple. Okay, and they're deciding on either option A, they're going to increase government spending, or option B, they're going to cut taxes. All right, now let's use the multiplier, making an assumption of an MPC of 0.9. Okay, so let's make an assumption of MPC of 0.9, and let's try to figure out what the total ripple is going to be. So if we choose option A, okay, then what we're basically doing is we're increasing government spending by $1,000, and then we need to multiply that times the multiplier. Now the formula for the multiplier is equal to 1 divided by 1 minus MPC, or which is the same, 1 divided by MPS. Okay, so it's either 1 over 1 minus MPC or 1 over MPS. And again, this is the same formula. It's the multiplier. Use a lowercase m for this. All right, so let's keep going over here. So 1,000 times the multiplier is if we do it on option A. Okay, so we got 1,000 times 1 divided by 1 minus 0.9, close parentheses. So we got to do 1,000 times 1 divided by 0.10. That's what this bottom portion is going to give you. And that's going to give you 1,000 times 10, or 10,000. So what this is basically saying is if the government spends $1,000, then your aggregate demand is going to shift to the right by 1,000. But then the total shift to the right from beginning to end is going to be equal to 10,000. So 1,000 is going to be the multiplier. 1,000 is going to be the government spending, and then 10,000 is going to be the total, or the theoretical total, from beginning to end. Now, of course, these 10,000 don't happen in 1 year, and this is one of the problems of trying to measure the multiplier, is that, as I said, the money doesn't just flow and, like a video game, immediately go into the next thing. It takes a long time for people to make a decision to purchase, etc., etc. So all of these ripple that I'm explaining over here takes a while to happen. You know, this transaction may take a couple of days, it may take a few days, it may take a few months, etc., etc., etc. All right. Now, if instead we go into option B and we decide to cut taxes, then the change in GDP is going to be equal to the 1,000. In this case, we have to make a negative 1,000, by the way, because we're cutting taxes by 1,000. Then we like to multiply times the negative multiplier in this case. The reason we turn it, by the way, into a negative multiplier is because we want to make sure that a decrease in taxes creates a positive change in the economy, which it does. All right, so we want to make sure that that number turns into a positive number. So we do negative 1,000, which is a cut in taxes, and then multiply times the negative multiplier. And then after that, we got to multiply times the MPC. Okay, so we already calculated the multiplier on the previous one. So this is going to be equal to the negative 1,000 times the negative multiplier, which is negative 10, and then times the MPC, which is 0.9. And that's going to give us 9,000. All right. So if we do it through a cut in taxes, what we're basically saying again is that economic activity or the aggregate demand is going to shift to the right, and the total ripple is going to be 9,000. Now, a question you may ask yourself is, why is it that a ripple of government expenditures is more than a ripple in tax cuts? And to understand this one, you got to go back to the original transaction. If the government spends money on you, they're going to ask you to do something on their behalf. In other words, what we call a government expenditure, you got to go back again to the slide, is a government expenditure is when the government either spends money because you work for them or they buy something from you. So a tax cut is when the government transfers money to you. That's not a government expenditure. Okay? So when the government transfers money to you, that's considered a decrease in taxes. When the government makes you work for the money that they gave you, that's a government expenditure. So basically, if you go back over here, an increase in government expenditure is going to create economic activity and in that transaction. And therefore, economic activity will be created from the original transaction. Then you got the ripple, and the ripple is the consumption side. If I decide to cut taxes, the government is not requiring to do anything. And then you're going to go ahead and spend the money, so the multiplier effect kicks in. But a tax cut, in a very basic way, is less efficient because it doesn't make you do anything to receive that money back. So if the government spends the money on you, they're going to say, okay, I'm going to hire you, I need some research. Or I'm going to hire you, I need you to build me a road. But if you cut taxes, the government just transfers money to you, but that transfer of money did not generate any physical economic activity. And then, of course, you go ahead and create a multiplier effect. So that's why you see an increasing multiplier that is higher for changes in government spending, and it's lower for changes in tax cuts. All right. If you forget those formulas, by the way, they're over here on this slide right here. So this is a change in GDP if you do it through purchases, and this is a change in GDP if you do it through a change in taxes. So if you lower taxes or if you increase taxes, the final effect really depends on whether people consume it or not. And this is where the MPC starts becoming important. So if you live in a country with a higher MPC or marginal propensity to consume, then the change in taxes create a larger ripple, or the change in government spending create a larger ripple. So the higher the MPC, the higher the ripple is going to be, because the higher the multiplier is going to be. One of the things that we need to have a conversation about is what we call the crowding out effect. And this is where the Federal Reserve needs to basically come in and provide some help. I want you to think about the world as having a sort of pool of money. And think about the US as having a pool of money. Okay? So if we have this specific pool of money, and the government has to come in, and they got to borrow a lot of money from that pool, then the government is going to steal a large portion of the money on that pool. As a consequence of that, there's going to be an increasing money demand. Money demand is going to shift to the right, and then interest rates are going to go up. When interest rates go up, it makes it more difficult for companies to invest and borrow the money that they need in order to go through the recession or survive or increase their expenditures. And it also makes it harder for you to buy things because they become more expensive. All right, and here's where the Federal Reserve kicks in. Because we don't allow interest rates to go up and down nilly-willy, what would happen is the Federal Reserve will come in and they will make the money supply shift to the right. By making the money supply shift to the right, they make interest rates go down, and then this never happens, which means that this doesn't happen. The amount of money being lost in the system, it's being replenished by the Federal Reserve in order to keep interest rates the same. So I want you to think about, as the government borrows money from the system, the Federal Reserve is expanding the pool of money available by basically putting more in the system. So in the US, there is very little crowding out effect. because we're pumping the money in as the government is borrowing the money. Now, there is a major side effect, as I was mentioning. The federal budget is going to go completely out of control. And you see that already in the national debt clock. Again, if you would have been around in January of 2020, this number right here would have been about $1 trillion in deficit, and now the number is at 1.8. This is the largest deficit in U.S. history, and it's about to get worse very quickly, okay? Because tax collection is in decline as the economy slows down, and as spending is going up very fast. So this is going to be one of the worst financial situations the U.S. federal government has found itself in a really long time. All right. This is just explaining that the government. Oh yeah, no, this is a cool slide. All right, so let's talk real quickly about this one, as what would be a sort of the best way to do this kind of stuff. All right, so the best way to manage the economy. And by the way, this has never happened. So we're just talking here about, like, the ideal world sort of thing. In the ideal world, you would expect this stuff getting ready for it, okay? So I want you to think about the business cycle. So the business cycle has this sort of going up and going down thing. When the business cycle is on the upswing, good things are happening, and the government has the ability to actually borrow money. Save money. So if when the things are doing well, taxation is going up because people are paying more money. If the government is able to cut back on their spending or maintain the level of spending that they have, then at some point the amount of taxes would be higher than the amount of government spending, and the government will be able to create a sort of savings account. Think about this as a sort of national wealth fund. Because inevitably, we're going to hit some kind of peak eventually, and we're going to go into a downturn. If the government had a savings account, then what we could do is basically immediately plug in that decrease in the economy by using the money that we have on the savings account, and we will be able to basically get out of that recession probably sooner. Because we don't have that money, again, we need to normally plug it in by borrowing money, and it takes longer for us to go down and to create that turn up in the economy. All right. So in the ideal world, what we will basically be doing is, as a government, we will be saving money during the good times and spending money during the bad times. And as soon as we create the upturn on the cycle, then we will go into savings mode again and create the next savings account for the next recession. The biggest problem with this is really politics. And I want to go back to this so you understand. In the year 2017, in the US, we cut taxes, supposedly to make the aggregate demand shift to the right and create the best economy ever. Recessions are inevitable. They're going to happen. They show up. We don't know why they show up all the time, but they happen. So at some point you hit that peak. It's impossible. At least we haven't seen it. It's not in the data. It is not historical. We have never seen a constant growing economy. Everything crashes at some point. So when you cut taxes in a moment in which economic activity is on the upswing, you go into borrowing money again. Because when you cut taxes, but then you keep the same level of government spending, or maybe you even increase the level of government spending, the only thing that can happen here is that you borrow more money because government spending becomes larger than taxation. So a cut in taxes while economic activity is on the upswing is not only unnecessary, but it puts you in a really bad financial situation for the next recession. And of course, like I've been mentioning, we did that cutting taxes in 2017, and then you find yourself in 2020 in the middle of one of the worst recessions in a very long time. And this, by the way, we're only at the beginning of it, but it seems like it will be, in terms of sharpness, probably worse in 2008. All right? So we'll see, by the way, because we got time. Notice that this is just the beginning, what's happening right now. It's only been going on for maybe 1 month. All right? A recession is at least 6 months of declining economic activity. And then the 2008 recession was 18 months of decline in economic activity. So again, this video was dating April 1st, 2020. And if you're thinking this is over, then you just don't know much about history. Okay? This is not even close. This is just the beginning of when things go down. So like a roller coaster, just hang on and hold on to those rails. All right. One of the things that eventually you also need to talk about is what we call supply side economics. Notice that if you push the aggregate demand to the right, you're going to create an increase in inflation. So as we push the aggregate demand to the right, inflation is going to kick in, and that's going to offset a lot of those gains in GDP. In order to be able to not have this inflation problem, we need to work on the aggregate supply as well as this is happening. So the government has to figure out a way to create some supply side ideas so that production increases as the economy is moving to the right, and then we end up at a lower inflation level than we would have if we only go on the aggregate demand side. Okay, so the inflation will be lower unless we don't generate changes in aggregate supply. So the idea is that in order for this to work and generate a better future for us, we need to be able to not only shift the aggregate demand to the right, but we also need to be able to shift the aggregate supply to the right. So the government has to generate ideas to make the aggregate demand and the aggregate supply both move to the right, so that in the future we end up with a lot of output generated but very little inflation. Otherwise, we end up in a much higher inflation level, in a sort of what we call hyperinflation level, which is bad and detrimental to economic activity. All right. Now, these are some examples of things that could generate some aggregate supply changes. Corporate tax reductions, for example. These already happened, by the way, in 2017. I don't think we can do any more corporate taxes in the U.S. reduction. Decrease in dividends and capital gains, so that investors put more money in the U.S. market system. Now, before I finished this particular chapter, there are two things that I like to mention, and this is just to dispel some of the misconceptions that people may have out there. The first misconception that people normally have is that the majority of taxes are paid by poor people in the middle class. If you look at the numbers that we actually have, the majority of taxes in the US are actually paid by the top 40% of the top 40% of the income tax bracket. They pay somewhere around 90% of all the taxes, while the bottom 60% pay very little taxes. So most taxes in the US, most federal income taxes, are paid by rich people. And this is the reason why when you do a tax cut, normally rich people receive more of the tax cut, because they pay more of the income taxes as well. Another thing that I like to dispel is that higher taxes on the rich are really bad for the economy. And I just want to give you a quick history lesson so you understand. All right? This is a quick history lesson of the highest marginal income tax rate in the US. And the highest marginal rate is the one that we apply for very rich people. Okay? So this is basically the taxes on the rich between 1913 to 2018. Notice that taxes on the rich between 1913 to 1916 were relatively low. And by the way, 1913, the reason it starts here is because this is the year where we started collecting income taxes. Okay? Notice that by 1917, that number was 67%. 18, 19, 20, 21, the number went up to about 73%. Then they went down, and we created what we call the Roaring 20s. All right? And the Roaring 20s was a fairly good economic period that culminated in the Great Depression of 1929. Then after the Roaring 20s came 1932-33. In order to conduct the majority of the stimulus that we did in the 1930s, we taxed the rich, basically. And notice how there was a huge increase in the tax rate for the rich between 25% to 63%. And that number went up all the way into the 40s. Now, this is, of course, World War II time. And then it stayed really high. Look at that, 1948, 1950. And it stayed up to 91% up until 1963. Then in 1964, we cut them back a little bit, 70%, then 75, then 77 by 69. And then if you go back to the 1970s again, we had a 70% or so. And then in the 80s is when they really started coming down. And this is during the Reagan administration, right? So I don't know which period in the U.S. you think was the best period, but anywhere between somewhere around here, the 1930s, to all the way until 1981 or so, taxes on the rich were extremely high. And this is the period that most people think is when the U.S. was at its golden age. In other words, after World War II is 1947, all the way up to about the 1980s. Then the 1980s show up, and we cut taxes on the rich down to like 50%. And then by 1987, the number went down to like 38 and 28. And this right here is when income inequality started skyrocketing in change in the US. So this is a time period where the rich have become richer compared to the poor. And this has been basically maintained. Now, during the Clinton administration, we raised the number for the rich from 31 to 39%. And we still generated a lot of income growth. This is the age of the internet, when it started becoming bigger. And then somewhere around here, 2001 or so, during Bush Jr. administration, we changed that number down to about 35%. And then we kept it around 35%. And then during the Obama administration, somewhere around here, we moved the number up to about 39%. All right, so anyway, this is a quick history of income taxes on the rich, in case you did not know. There have been plenty of times where income taxes on the rich have been extremely high and economic activity was fine and growing and in good shape. All right, so anyway, to dispel two things about taxes in the federal government. I hope you have some fun in this chapter. This is Professor Choi. Have a good one.